guest is doubling down on his call that we are in for a volatile first half of 2024. Wells Fargo Securities head of equity strategy, Chris Harvey, joins us now. Chris, great to have you. In terms of volatility in the first half, like a decline from here, or volatility moving higher? Because it seems like we're just going to new highs here.
I think volatility will spike up. I think what's going to happen is things are going to get a little bit, we'll see a repricing of risk, right? So typically when we're coming out of the big micro period, you have earnings season, we're moving over to the macro. Yesterday, we got a taste of what happens when the macro takes over. That wasn't great. The other thing that we're talking about is that things are actually good on the macro side, which is going to keep the Fed at bay. If we roll the clock back 12 months ago, we say, okay, GDP is going to be better than expected. Stocks are going to be up 20, 25, 30%. Credit spreads are tightening to below 100 basis points. The consumer was at, consumer net worth is all-time highs, right? And the job situation was still good. Would we be saying, yeah, now's a great time to lower rates? We'd say no. In actuality, this is a time where you actually raise rates. That's not going to happen, but we think it's going to be, you're going to see the Fed being pushed back and pushed back and pushed back, and we're just going to see a repricing of risk at this point in time.
So in terms of that repricing of risk, I'm curious to whether or not Nvidia's results is going to be sort of a key test for you as to whether or not that repricing will actually happen.
So I think what's good for Nvidia is good for Nvidia, right? So Nvidia is up 50% year to date, right? So just shifting a little bit, I run or oversee one of our model portfolios. That model portfolio is up, we're outperforming by about 200% or 2% year to date. We have 10% in cash. In a typical environment, that shouldn't work. That shouldn't occur. But what's good for Nvidia, right? So Nvidia is driving that performance. Nvidia will continue to drive that performance, but it's not driving the average stock higher, right? What we're seeing is rates go higher. That's weighing on the average stock, and Nvidia will do what it does, right? It's not an indication of the broader market.
But it's an indication of the Magnificent Seven, which has been driving the gains of the broader market.
Which is the broader market.
Right.
It is the market.
It is, right?
Or I should say the average stock, right? If you look at small caps, you look at mid caps, you look at value, you look at equal weighted, it's flat to down this year, right? And that's being weighed on to a certain degree because guidance fundamentals are fine, but they're not great. Rates are going higher. So as long as you're part of that Magnificent Seven, fantastic. If you're not, it's tough sledding.
So would you be saying that you should buy protection? I mean, we saw, other than yesterday's spike in the VIX, which maybe I don't even know if the VIX is such a good instrument to look at anymore, that it was down down almost what it was up yesterday. Are you saying you should buy protection there? It's cheap.
So what we're saying is we want to participate to the upside and we want to protect to the downside. The way we're doing that is we're positioning the portfolio with communication. We want something GARPy, something growthy. That's communication. Communication is working. We want to balance that out with something more defensive, something oversold. That's healthcare, and to a lesser degree, it's utilities. And we think that portfolio is the portfolio you want to run going forward, whether you're a bull or a bear. And year to date, we've been running this portfolio, for the last 12 months, and it's worked out very well. And I think in a difficult tape, that's going to work as well. And year to date, to the upside, it's performed quite well.
Now, you just pointed out a few minutes ago here that like small caps and value, a lot of people coming into the year said, oh, the markets are going to broaden out. Yeah. That's where it's going to be. That has not come to fruition.
Right.
And I'm just curious, so when you're positioning a portfolio or if you're recommending that to anybody, should they have an allocation there? How much there compared to the Mag 7? Like how much do you want to, is that some of a FOMO trade that's going to continue to rise, or do you want to have money there still?
So it's our opinion that you shouldn't see a widening out. Right, that small caps are not going to work. What happened last year at the end of the year is what occurred is you had a lot of short covering. You had a lot of hedge funds shrinking up their book. That caused the dynamics to look like things were broadening out. Then year to date, you saw a reverse. As the calendar turns, everything reverses. Right, the underlying fundamentals for small cap, they're not great. The macro, what you need for small caps to work is a really big run in the economy, really big upward revisions. You're not seeing that. The other thing you need is you need to see credit spreads come down. Credit spreads are already tight. So this environment's not great for that. This is an environment where there's a lack of growth. You're looking at 2.25% GDP growth. And in that environment, you still want to stick with growthy stocks because of the scarcity of growth.